Imagine waking up one morning and realizing the problem isn't that money is gone. The problem is worse. Money is still there, but nobody believes in it anymore. Not belief in cash, belief in credit. Because modern finance doesn't run on dollars, it runs on trust, stacked on top of trust, multiplied by promises about the future. And when credit stops trusting itself, the system doesn't slow down, it snaps. This matters right now because the global economy is quietly built on an assumption that has never been stress tested at this scale, that trust can always be rolled forward. Every mortgage, bond, credit card, corporate loan, government deficit, all of it assumes tomorrow will be stable enough to honor today's promises. But history shows something uncomfortable. Credit doesn't fail gradually, it fails socially. Let's talk about how this system actually works and what happens when it doesn't. At its simplest, credit is just delayed belief. I give you resources today, you promise to return more later. That's it. But once that simple exchange is scaled up, layered, packaged, insured, traded, and rehypothecated, something strange happens. The lender stops caring about the borrower. They care about who will buy the promise next. Banks don't hold loans anymore, they sell them. Funds don't wait for repayment, they trade expectations. In theory, this spreads risk. In reality, it spreads responsibility so thin that nobody feels it. Credit markets don't ask, will this be repaid? They ask, will someone else believe it will be repaid before I need to exit? That's the quiet rule nobody says out loud. Now zoom out. Banks lend to corporations. Corporations borrow to buy back stock. Funds buy corporate debt because it yields slightly more than government bonds. Pension funds buy those funds. Central banks stand behind the system as the buyer of last resort. Each layer trusts the next layer's math. And the math assumes liquidity. Liquidity means you can always sell, not at a fair price, just at any price. That's where the illusion lives. Because credit only feels safe when markets are calm, and markets are calm only when everyone agrees not to test the exits at the same time. So, what breaks first? Not defaults, doubt. One institution pauses, another widens spreads, a third quietly stops rolling over short-term funding. Nothing collapses yet, but the tone changes. Suddenly, overnight lending costs tick up, repo markets get tense, collateral is questioned. The same asset that was safe yesterday now needs a haircut, then a bigger one. This is the moment credit starts mistrusting itself. In 2008, it wasn't that banks suddenly realized mortgages were bad. They realized they couldn't trust each other's balance sheets. Lehman didn't fail because it lacked assets. It failed because nobody wanted to be the next one holding its promises. When trust disappears, prices stop being prices. They become guesses. And guesses don't clear markets. Here's the uncomfortable math most people never see. Modern financial systems are leveraged by design, not recklessly, systemically. A small decline in asset values doesn't cause a small problem. It forces selling. Selling pushes prices down. Lower prices trigger margin calls. Margin calls force more selling. This isn't panic, it's automation. Risk models say reduce exposure. Compliance says de-risk. Funds say protect redemptions. Everyone does the rational thing at the same time. And suddenly, credit instruments that were supposed to be long-term become unfinanceable overnight. That's when central banks enter the story. Publicly, they talk about stability. Privately, they talk about plumbing. They don't save markets because prices are unfair. They intervene because payment systems are at risk. If credit freezes, companies can't roll short-term debt. If companies can't roll debt, they miss payroll. If payroll misses, the economy isn't abstract anymore. So liquidity is injected, rates are cut, facilities are created. From the outside, it looks like confidence. From the inside, it's containment. But here's the irony. Every rescue teaches markets the same lesson. Trust doesn't need to be earned. It will be backstopped, which changes behavior. More leverage becomes rational, shorter time horizons feel safer, risk migrates into darker corners where regulation can't see. Credit grows not because fundamentals improved, but because the cost of disbelief feels higher than the cost of faith. Until it isn't. At some point, the numbers get too large to ignore. Debt grows faster than income. Interest costs outpace growth. Refinancing depends on rates staying low forever. This is where the public story and the private reality diverge. Publicly, everything is manageable. Privately, institutions hedge tail risk. Publicly, markets celebrate resilience. Privately, liquidity buffers are raised. Nobody wants to be first to say the word fragile, because fragility is contagious. And that's the final twist. Credit doesn't collapse because people are greedy. It collapses because they are rational within a fragile structure. The system works beautifully until everyone tries to protect themselves at once. At that moment, trust becomes a finite resource. You can't print it, you can't model it, you can only borrow it from the future. And when the future looks uncertain enough, even perfectly sound borrowers get punished. The long-term risk isn't a crash. Crashes are visible, they reset narratives. The deeper risk is a world where credit exists but trust doesn't, where lending requires constant intervention, where markets function but only under supervision. That's not a failure, it's a transformation. The question isn't whether credit will break again, it always does. The real question is quieter and more unsettling. How many times can a system teach itself not to trust before trust stops coming back at all?